Now, we heard from Ron earlier about how a passive investing approach using products like ETFs can give you an effective and low-cost exposure to the larger end of the market. But the approach we take to the smaller end of the market is very different because we think there's an inefficiency at the smaller end of the market, and so then we want to take advantage and exploit that inefficiency with active management. So why is there an inefficiency at the small end of the market? Well, the answer is in the table in front of you now. This table has all of the companies on the ASX, and it's organised them by their market caps. So at the top are the larger companies, and at the bottom are the smaller companies. Now, you'll notice in the top row that there are 4 companies with a market cap greater than $100 billion. I'm sure we can all guess what those companies are: Commonwealth Bank, BHP, Rio Tinto, and Westpac. Now, what's interesting about those 4 is that there are 84 analysts who spend their working hours, estimating the company's earnings, thinking about the strategy and the competitive advantage, and ultimately trying to determine whether the stock price is an accurate representation of the company's value. And that works out to be, for those 4 companies, 21 analysts on average. Now, what's interesting is that when you work down the table and start to approach smaller and smaller companies, you'll see on the right at the bottom that a $100 million company is lucky to have a single analyst covering its stock. And in fact, most smaller companies don't have any analysts covering their business. Now, in a competitive pursuit, which active management is, our greatest chance for finding mispriced opportunities is where no one's looking. So the small end of the market holds great potential for that. So what are we doing about it? Well, at Intelligent Investor and InvestSMART, we launched a small companies fund in February this year. And we've had success thus far finding some mispriced opportunities, and we've managed to achieve a good return above our benchmark to date. But it's early days, so we're really thinking about the long term with this product. Most of the people involved, in fact all of the people involved, have an investment in the product. So we're really trying to add some value with this product and formulate a portfolio of really mispriced opportunities. We can talk more about the product later on. I talk to lots of people about smaller cap investing, and it amazes me that most people have a very disciplined approach for the biggest part of their portfolio, but when it comes to small cap investing, they seem to throw that all away and start focusing on blue sky hopefuls or speculative miners, and they seem to just take a gambling approach like they're at the racetrack or the casino, and that's not what we do with smaller companies. We're bringing the same approach we use for larger companies, and we bring that to the smaller end of the market. So we're using many of the things that Gaurav has just touched upon. So we're looking for companies with competitive advantages. Small companies can have them too. They can dominate particular niches. And a competitive advantage allows them to earn good returns and to do so on an ongoing basis because that advantage keeps the competition away. But we're also willing to invest in truly mispriced opportunities. So these might be lower quality companies, but the mispricing compensates us for that. So how do we go about finding ideas? Well, we use many of the tools that other people do. We're using screening tools, visiting lots of companies, speaking to other people in the market and other analysts, and reading widely. But overall, the overarching theme that we use is independent thinking. We need to understand the companies for ourselves. Oftentimes there's no research on these companies, so we need to formulate our understanding from the ground up. And we need to form our own views and do so on our own. And also psychology. Psychology is a great creator of investment opportunities. Terrible headlines make for great investment opportunities. So we like to think about where psychology might be really skewed in one direction or another, and how that can create opportunity. And right now in Australia, the retail sector is very pessimistic. Retailers are worried about what Amazon is going to do to their business. Amazon has initially launched in Australia. The economic conditions have been tough, and there's been many retail downgrades, and the stock prices for retailers are really low. So with that type of environment, it's an area where there could be mispricings, and we've been combing through that, but we haven't been able to find any because we are reasonably cautious there. They have a lot of financial risks with their lease liabilities, so we've been very cautious there. But it's just an example of how pessimism and psychology can potentially create ideas. and also time horizon. It amazes me how short-term focused most investors are, professional investors who are thinking about the next 6 to 12 months. So we think if we can think in longer time periods, invest in ideas that fall into that category, we can get another edge over and above. So now I'd just like to run through 3 ideas that we have invested in the portfolio. And the first idea is global construction services. It's a pretty simple business to understand. It's a Western Australian-based scaffolding business. It's quite a capital-intensive business initially. They need to invest in their equipment, which is just simple scaffolding equipment. And they lease that to their clients on a per tonne, per day basis. And they're diversified across residential, commercial, and mining construction services. Now, an important differentiation about their business is the leasing model of their revenue profile. Now, the construction sector is notorious for downgrades and even bankruptcies because many contractors often take fixed price risk on their contracts. So that means if the project takes longer and is more costly to complete than expected, the contractor stands to incur that loss. But what's different about GCS with its rental model is that if its scaffolding is installed on site and it takes longer to complete, they're in a position to earn more revenue with no incremental costs, so that they actually benefit from that. So why was there an opportunity in global construction services? Well, it really stemmed from a mistake, a capital allocation mistake the company made at the turn of the mining boom. So just when the outlook for revenue in their mining business was starting to deteriorate, the company made a debt-funded acquisition into general equipment hire. So just when the revenue prospects were starting to become more uncertain, the company added lots of debt to its balance sheet, increased its financial risk, and this concerned a lot of investors. So as you'd expect, many shareholders sold the shares off. The brokers that covered the company in the boom years gave up the coverage and completely deserted the company in the bust. And then GCS had to enter a period of balance sheet repair where the great cash flow that it was generating couldn't be used to repay shareholders or to grow the business. It had to use that to repay the bankers. So there were no dividends and everyone essentially gave up on the company. But you'll see in the chart in front of you now that over a period of about 5 years, the company did great work repairing their balance sheet. And there was an inflection point in late 2016 where GCS actually became net cash. And it was at this time that we took an investment in GCS, doing so on about a 20% free cash flow yield. And GCS also had 2 other assets that weren't contributing to its earnings that it was looking to sell, which could strengthen its balance sheet further. So why was a company like this, with a strong balance sheet, throwing out 20% cash flow returns to shareholders available? Why should that exist? Well, again, we think it was psychology. Investors were worried that the company would repeat previous mistakes. They were fearful about this type of company and the sector in general. So I think we were unburdened by having been in the space for a long time. We could approach the sector with fresh eyes, and we didn't have that emotional baggage of having been invested in it for a long period of time. So how did that play out? Well, shortly after we invested, GCS sold those 2 non-core assets, and that brought in an additional $40 million of cash. And one of the assets was sold, and that locked in a tax loss with the ATO, and that will save the company about $20 million in tax payments in the coming years. So almost immediately, $60 million of value came into the company, and that was about half the market cap at our investment price. With a strong balance sheet, the company reinstated its dividends, paid special dividends, and it's even expanded into the East Coast. And what's noteworthy about that is that the company has shown that they've learned from the mistakes through their expansion into the East Coast. They've done so in a very intelligent, low-risk, low-cost way, so we applaud them for that. And one more thing is the potential opportunity that stems from a disaster in the UK. You might have heard on the news that there was an apartment building there that caught on fire and it burned to the ground because the cladding that was used on the apartment was made out of a flammable polyethylene product. What's the implication of that is that Australia has used this product widely for decades, and it could mean that we may need to audit and replace many of the cladding that's installed throughout Australia. So for a company that provides scaffolding and also has a cladding business, it's in the box seat to get some of that additional work. The next idea I'd like to talk about is in the for-profit education space. And if you don't already know, Australia is actually a world leader in education. We consistently rank in the top 4 for international student enrolments alongside the US, Canada, and the UK. And it's easy to see why. We have a great society, great entertainment options. We've got an English-speaking society, developed world economy, so there's great job prospects after graduation. And we're located close to Asia, so many people want to come here to study and learn, and many do. And the sector has grown very strongly at double-digit rates for a number of decades. But the problem for investors has been getting exposure to that, because the sector has been rife with crooks and cowboys. You may have heard about the vocational education crisis, where many listed and private companies took advantage of government funding, and they did so to enrich themselves at the expense of the students ultimately, because they took the money and provided very, very poor educational outcomes. But what happened was that the government identified that, clamped down, and there's been hundreds of companies that have had their licences pulled, and they've essentially been put into administration. And the chart on the right there shows just the number of companies that have been removed from that sector. So these two forces acting together interest us a lot, because you've got a sector which is growing strongly, but you're having all the players in the sector pulled out of it. So it means there's great opportunities for the survivors. So we wanted to identify who the survivors were they good operators, and could they be trusted? So how did we go about doing that? Well, the first thing we did is we looked at what the insiders of the companies were doing themselves. We looked at the director purchases of their own shares, and quite quickly one company came to the fore, and that was a small education company called Identifies Australasia. And I have never seen director buying like this. They were buying shares hand over fist consistently for more than a year. So this gave a very strong signal to us that the insiders of the company who were closest to the business thought that there was a mispriced opportunity there. They thought the company was strong and it was worth a lot more than what the share price indicated. So then what we did is we looked into whether those insiders were good investors. Should we actually listen to that signal? And we found that those same directors had made an investment back in 2011 in another educational company. They did so when its share price had sold off, and they actually just sold it a few days ago. And they made a return of about 15 times on that initial investment. So we were quite interested in these two signals. Buying heavily in their own stock, and then there's an example that they know how to take risk, they understand educational companies, and they're willing to back that view with their own money. So that company, as I said earlier, is Identifies Australasia, and it's actually Australia's oldest listed education company. Its company number is 3725, so it's actually one of the first 4,000 companies in Australia. And it has 18 colleges in Australia and 1 in Singapore, and I'm actually about to tour 4 of them after I finish up here. And it mostly educates full fee paying international students, so it's benefiting from that big tailwind of students coming to Australia. And what's interesting about it is that investors are slow to trust players in the space, and we can see that through the multiple at which it trades at, which is less than half of what Navitas trades at. So again, we think that's investor psychology, still very fearful about the space in general, and that's offering opportunities to buy into some decent little companies. Now, the last idea I'd like to talk about is a company some of you might have paid money to. It's a red light and speed camera company. It's been around for a few decades, and it initially had great success growing throughout the world. Built a big business in the US and in Asia and Europe. So much so that it attracted a takeover offer from Macquarie. The directors will be very upset that they didn't accept that offer of $2.75 per share, because shortly after they knocked it back, it was found that some of the employees had bribed officials in Chicago to win work. And so quite quickly there was a criminal and a civil investigation lobbed onto the company. So the company entered crisis. The civil litigation penalty was speculated to be about $300 million. So if they had to pay an amount anywhere close to that, it would have surely bankrupted the company. So the share price quickly fell to a level equivalent of about 1 times operating profit. The company cleaned out all the old directors, completely restructured the board, restructured the organisation, and did its best to show that it was operating in good stead. But it's really hard to overemphasise just how held back the company has been. They've had to invest all of their time at the senior management level addressing legal issues and focusing on making sure the company didn't go bankrupt, essentially, instead of focusing on growing the business. They've had to stockpile capital to fund a potential litigation payment instead of using it to reward shareholders or grow. And it's been very difficult to attract talent or new work, because why would you award work or join a company if you thought it was going to go bankrupt in the future? So the company's been held back for more than 5 years. You might be wondering, why would we want to get interested in a company that has an issue like this going on? And the reason is the company's recently settled its legal issues, and it's only had to pay $20 million. So it was a manageable payment. They had cash stockpiled for that, and it means that they've put all those issues behind them. So it means we can now start to focus on the company's attributes and what the future holds for it. So why do we like Redflex? Well, I could talk about this for a long time, but I'll just focus on a few things. And Redflex has a very significant international network already. In the US, it has 1,000 cameras, and it actually owns those cameras. So it's had to fund the upfront cost of that, and it doesn't come cheap. Each camera costs around $100,000 US. And just to give you an indication of why it's so expensive, that's because they have to dig a hole, source electricity to the site, install a pole and a housing which houses the camera, and then integrate that with both the cameras and the back office. So it's a very expensive process. And with 1,000 cameras, that gives you a replacement value of around $100 million US. Now, what's interesting about that is how it plays out when the company retenders its contracts. It usually has 5-year contracts with cities, in some cases longer, and then the contracts are retendered. And so when competing bidders bid for the contract, they have to include the contract of replicating the infrastructure in their bid, where Redflex doesn't. So it almost always re-wins its contracts, and that delivers a nice steady stream of recurring earnings, because it gets paid a fixed fee per camera for 70% of its cameras, and it shares in the fines paid on the other 30%. And Redflex is also in a position to boost its earnings quite considerably from here. They've cleaned out a lot of cost. They've actually secured a large contract here in Australia, and they've actually recouped some bad debts that they'd previously written off. And they're also in the midst of raising capital as we speak, and they're using that to pursue some of the big opportunities they've seen in international markets, where the reputational damage in the US hasn't affected them. We also think that there's a potential for Redflex to be taken over, because it has lots of strategic value and lots of just financial value as well. And I'll take a moment to describe that. Redflex's main competitor in the US is American Traffic Solutions, and it was recently taken over by a private equity company. And the private equity company has a history of buying 2 competing companies, putting them together, stripping out the duplicate costs, and then benefiting from the synergies there. Now, what's interesting is that they could try and replicate a 1,000-strong network of cameras in the US, or they could buy Redflex for $60 million, which is less than the cost of building the network. And they're a US-centric business, and they don't have their own technology. So buying Redflex gives them exposure to the international markets, and also allows them to boost their margins by installing their own technology on existing contracts. But it's fair to say that's just the cream on the investment case, because it's largely predicated on a strong earnings uplift from here, and entering on a 4 times multiple, we think it's a fairly intelligent bet. So that's all from me. Thank thanks for listening. We're now going to have a bit of a Q&A panel. And so if you have any questions, there'll be a microphone going around the crowd, and please direct the difficult ones to Ron.